I'm Sarah, a tutor here at Accountancy Learning, and in this video I'll take you through the Level 3 Financial Accounts AAT Sample Paper 2 Task 6. So this task is going to be about preparing accounting records from incomplete information. Ian printed a report from the accounting software system. The report suggested his closing balance of product TP2 was 368 units, valued at £1 per unit, and we're told that TP2 is a small component. An inventory count revealed that he and Ian held 378 units, also valued at £1 per unit. So part A, identify whether each of the following could have accounted for this difference. So first of all, we've got the software is saying there's 368, and physically, in the physical count, we have 378. So our physical count is higher than what the software is saying. And that's really important that before you start working out whether this could or couldn't account these differences, these situations, it's really important that you have in mind which is higher. So the first one, theft of inventory by members of staff. So our physical count is higher. So if there was any theft happening, then it means that our count would be lower because we'd be expecting a certain amount in stock based on the software, and there would be less actually in stock physically. So that could not account. A purchase credit note has been entered twice onto the accounting system. So because we're talking about purchase credit note and it's been entered twice, that means that if we've returned goods, so we've physically returned some goods to the supplier, to the manufacturer, and then we've received a credit note and we've put that on, when we put the credit note on once, our levels will balance. And then if we duplicate that, it means our physical stock is going to be higher than our software. So that could account. And remember, we're always going back looking at what was higher. A box of TP2 had been omitted from the inventory count. So this means this wasn't counted when they done the physical check of stock. So it means if it's been omitted, then when they add it in, then our physical stock would then get even higher. So it doesn't account for the fact that we've got this current difference. And then finally, production had returned a number of the components unused, but this had not been recorded. So if production have sent back a number of the TP2 components, it means that physically we wouldn't have as many because they've physically sent those items back, but it hasn't yet been recorded, which means the software is still going to think that production have got those items. So that means that it would be able to account for the difference. Next, complete the following statement. If the closing inventory reported was too high, this could lead to the gross profit being, and we've got to select whether it's understated or overstated, and the current assets being understated or overstated. So in order to go through this question, it's worth trying to put some figures to what we're actually talking about. So we know that our gross profit is our revenue minus our cost of sales. So now we need to break that down. So our cost of sales is equal to the opening inventory plus our purchases minus our closing inventory. So if we now replace these with some figures, then we can see what's going to happen to the cost of sales if the closing inventory is too high. So let's say we have opening inventory of 10,000. We have purchases of 20,000 and we have closing inventory of 5,000. So that would then make our cost of sales 25,000. But what would then happen if we changed our closing inventory to 2,000? So instead of 25, we would have 10,000 plus 20,000, and this time we'll minus the 2,000, which gives us 28,000. So this is two different cost of sales based on different closing inventories. Now we can put in a figure for, let's say, revenue, and let's just say we have a revenue figure of 70,000. So based on our cost of sales figures that we have created, we are going to have 70,000 minus 25,000 for gross profit for this scenario here, and we'll have 70,000 minus 28,000 for our gross profit here. So we've got 45,000 gross profit when we've got a cost of sales of 25,000. And then we've got a £42,000 gross profit when we have the £28,000 cost of sales. So now going back to what we need to answer, we're saying if the closing inventory was reported too high, this could lead to the gross profit being, now if it should have been 2,000, but they reported it at 5,000, it means that our gross profit should have been 42,000 here. That's our £2,000 closing inventory. This is our £5,000 closing inventory. So if our actual closing inventory was 2,000, but it was reported at 5,000, it means our profit is showing as much higher. So therefore, it would be overstated. The next part of the question is the current assets being overstated or understated. So your current assets, this is your inventory. So we're going to be looking at our closing inventory figure. So again, if looking back at our figures, if it was meant to be 2,000, but it's actually been reported as 5,000, it means that asset figure for the inventory is then going to be too high. So again, that would be overstated. Next, you are preparing the accounts for a sole trader and have been given the following information for the year ended the 30th of June 20x8. Sales including VAT were £76,080. Your client uses a gross profit margin of 30%. Purchases excluding VAT for the year were 48,390, and inventory as at the 1st of July 20x7 was 5,050. So before we start answering the question, this inventory here, this is opening inventory. This is at the start of the financial year. So the first part is that we need to calculate the value of the sales net of VAT. So we've got sales of £76,080, and that's VAT inclusive, so that includes VAT. So we then need to divide that by 1.2 or 120, depending on which way you like to do it, to give us our net figure of 63,400. Next, we now need to calculate the cost of sales for the year. So this is where we now need to start using some of the other information that we're given. So the question tells us we have a gross profit margin of 30%. Now, for margin, the key part of that word is in. So all in equals 100%. So because we're using margin, it means our sales are going to equal 100% and our cost of sales is going to equal 70% because our margin is 30%. This is different to markup, where you would use cost of sales at 100% and then step up by your markup percentage. So we're doing margin. So remember, we've got the in there to remind us that we're basing it on 100% sales. Cost of sales is 70. So therefore, our calculation will be 63,400 multiplied by 70% to give us 44,380. And then we need to calculate the inventory at the end of the year. So this is our year-end date. So we're going to be using our cost of sales formula here. So let's remind ourselves, cost of sales is equal to our opening inventory plus our purchases minus our closing inventory. So now we need to use our math skills in order to put the figures in and then rearrange our formula to find out what our closing inventory is. So cost of sales, we've already just worked out at 44,380. The question tells us that our opening inventory was 5,050 and our purchases, and this is already excluding VAT, was 48,390, and then we would take off closing inventory. So the figure that we're finding is this one here. So now we're going to rearrange that formula. So remember, when you then put something on the opposite side of the equal sign, it changes the symbol that you're using. So the minus here, we're going to want to change to a plus. So we're going to move that to that side. So then that will then become CI. So that's our closing inventory. And the way it reads at the moment would be plus 44,380 equals 5,050 plus 48,390. But we actually then want to take this out of here and move it to the other side. So it then becomes a minus, which then gives us the closing inventory formula. Once you do that calculation, you get the closing inventory of 9,060. Another client, Melissa Rose, sells dolls for £48 and previously purchased the dolls for £40 each. She's not registered for VAT. This means that she has and then we need to decide, is it markup or margin of 20%? So she sells at 48 and she bought them at 40. So we've got an £8 difference there. Now we're looking for 20%. So if you divide the £8 difference divided by the cost of 40, that equals 20%. So this is basing it on the cost of sales. So this is going to be a markup because our cost of sales is 100% and we're stepping up by 20%. And we can prove that then by taking our cost of sales and we're going to multiply it by 1.2 because we're adding on that 20%, and that gives us 48. So we know that we have that right. This then brings us to the end of task 6.